Welcome to G Fun Facts Online. Every day, powerful, often invisible forces shape our wallets, our job prospects, and the health of the entire global economy. At the center of this complex machine is an institution often referred to as the economy's engine room, the central bank. Whether it's the Federal Reserve in the United States, the European Central Bank, or the Bank of Japan, these bodies wield immense power. But how do they do it? What are the levers they pull? And what happens when the old levers stop working? Today, we're going inside the engine room to explore the evolution of central banking tools. From the disastrous mistakes of the past to the radical experiments of today and the theoretical ideas of tomorrow, we'll look at the people who made monumental decisions, the crises that forced their hands, and the ongoing debate over how to best steer the ship of the economy toward collective prosperity. Let's start in a period that many would like to forget, the 1970s, an era defined by what economists call the Great Inflation. In the United States, prices weren't just rising, they were spiraling out of control. The cost of living was soaring, economic growth was stagnant, and public confidence was plummeting. At the helm of the Federal Reserve for much of this turbulent decade, from 1970 to 1978, was a man named Arthur F. Burns. Burns was a respected economist, but he found himself caught in a classic trap: political pressure. President Richard Nixon, who had appointed Burns, was intensely focused on his 1972 re-election campaign. Nixon wanted a booming economy to secure his victory, and that meant he wanted the Federal Reserve to keep monetary policy loose and interest rates low. Recently released recordings from the Nixon tapes reveal the extent of this pressure. In conversations, Nixon would directly and sometimes aggressively urge Burns to stimulate the economy, even if it meant risking higher inflation down the line. Burns, despite the Federal Reserve's ostensible independence, largely acquiesced. He pursued an expansionary monetary policy, keeping interest rates too low for too long. The short-term result was a temporary economic boost that helped Nixon win re-election. But the long-term consequences were catastrophic. By prioritizing short-term political goals over long-term price stability, the Fed unleashed an inflationary beast. Inflation, which was already a problem, accelerated dramatically, eventually reaching double digits. The public lost faith in the dollar and in the Fed's ability to manage the economy. The experience under Arthur Burns became a textbook example of what happens when a central bank loses its independence and its focus on controlling inflation. The economy was sick, and the medicine applied had only made the disease worse. A new, much more painful treatment was required. By 1979, the situation was untenable. President Jimmy Carter appointed a new Federal Reserve chairman, a towering cigar-smoking figure named Paul Volcker. Volcker understood that the credibility of the Federal Reserve was in tatters and that half measures would no longer work. He had one primary mission: to break the back of inflation, no matter the cost. His strategy was brutally simple and direct. He dramatically tightened the money supply and allowed the federal funds rate, the key interest rate controlled by the Fed, to rise to unprecedented levels. In 1981, the rate peaked at a staggering 20%. To put that in perspective, a typical mortgage rate during this time could be as high as 18%. This policy became known as the Volcker Shock. The immediate effect on the American economy was severe. The high interest rates choked off borrowing and investment, plunging the country into a deep recession. Unemployment soared to over 10%. Businesses failed, farmers lost their land, and Volcker himself received death threats. He was, for a time, one of the most hated men in America. Yet, he held his nerve, and slowly but surely, the policy worked. By 1983, inflation had fallen from a peak of nearly 15% down to around 3%. The Volcker shock was painful, but it was successful. More importantly, Paul Volcker re-established two crucial principles. First, the primary role of a central bank is to ensure price stability. Second, the central bank must be independent from short-term political pressure to achieve that goal. For the next quarter century, The Volcker model of targeting inflation with interest rate adjustments became the undisputed orthodoxy for central banks around the world. But then came a crisis that this model wasn't designed to handle. The financial crisis of 2008 was a different kind of monster. It wasn't about high inflation. It was about the opposite. The global financial system was on the verge of collapse, credit markets froze, and the world faced the terrifying prospect of a deflationary spiral, a vicious cycle of falling prices and wages reminiscent of the Great Depression. The Fed, now led by Chairman Ben Bernanke, a scholar of the Great Depression, responded in the traditional way. It slashed interest rates. But by December 2008, the federal funds rate was effectively at zero. The primary tool in the central bank's toolbox was now useless. They had hit the zero lower bound. They couldn't cut rates any further, but the economy was still in free fall. This forced Bernanke and other central bankers around the world to open up a new, unconventional toolbox. The first and most famous of these new tools was quantitative easing, or QE. In simple terms, QE involves a central bank creating new digital money to buy financial assets, primarily long-term government bonds, from commercial banks. The goal is threefold. First, by buying up these bonds, the central bank increases their price and pushes down their yield, which helps lower long-term interest rates for mortgages and business loans. Second, it injects liquidity into the banking system, hoping to encourage banks to lend more. Third, it signals to the public and to markets that the central bank is committed to keeping monetary conditions easy for a very long time, which can help boost confidence. QE is not the same as just printing money and giving it away. It's an asset swap. The central bank swaps its newly created reserves for an interest-bearing asset, like a bond. This tool, first pioneered on a large scale in Japan to fight its own lost decade of deflation, was deployed on an unprecedented scale by the Fed, the European Central Bank, and the Bank of England after 2008. But even QE has its limits and critics. Some argue it primarily benefits the wealthy by inflating the prices of stocks and real estate. Others worry about the long-term consequences of central banks having such massive balance sheets. This led to discussions about an even more radical, and still mostly theoretical tool: helicopter money. The term was coined by economist Milton Friedman in a 1969 thought experiment. Imagine, he said, that one day a helicopter flies over a community and drops $1,000 in cash from the sky. The people below would rush to scoop it up and, most likely, go out and spend it. This would directly boost spending, economic activity, and ultimately, inflation. Helicopter money is fundamentally different from QE. QE works indirectly, through the financial system. It gives money to banks in the hope they will lend it out. Helicopter money bypasses the banks entirely and puts cash directly into the hands of the public. This could be done by sending a check to every household, or through a direct deposit into their bank accounts. Proponents argue it would be a far more powerful tool for fighting deflation because it directly targets consumer spending. However, it is considered a nuclear option by many. Critics fear it would be impossible to control the resulting inflation. Once you start the helicopter, how do you stop it? It also blurs the line between monetary policy, which is controlled by the central bank, and fiscal policy, government spending and taxation, which is controlled by elected politicians. This could fatally undermine the central bank's independence that Paul Volcker fought so hard to secure. The experience of the last 2 decades has shown that central bankers can't afford to be complacent. The world is always changing, and new challenges require new ideas. This has sparked a fascinating debate among economists about what the next generation of monetary policy frameworks should look like. 2 prominent ideas have emerged: price-level targeting and nominal GDP targeting. Let's first look at price-level targeting. Most central banks today, including the Fed, practice inflation targeting. They aim for an inflation rate of, say, 2% per year. But what happens if they miss? If inflation is only 1% one year, under a simple inflation target, they still just aim for 2% the next year. the shortfall is forgotten. Under price level targeting, the central bank would not target the rate of inflation, but the overall level of prices. They would commit to a predictable path for the price level over time. So if they undershoot their target and inflation is only 1%, they would then have to aim for 3% inflation the following year to make up for the shortfall and get the overall price level back on its predetermined path. The key benefit is that it creates stronger expectations. If everyone knows the central bank will correct for its past misses, it makes monetary policy more credible and powerful, especially when stuck at the zero lower bound. An even more ambitious idea is nominal GDP targeting, or NGDP targeting. Nominal GDP is the total amount of spending in an economy without adjusting for inflation. It's basically real economic growth plus the inflation rate. With NGDP targeting, the central bank would commit to keeping total spending in the economy growing at a steady rate, for example, 5% per year. This framework has a powerful, built-in stabilizing property. Imagine a recession hits and real economic growth falls. To keep total nominal spending on its 5% path, the central bank would have to automatically allow for higher inflation. This would cushion the blow of the recession. Conversely, if the economy overheats and real growth is too fast, the central bank would be forced to tighten policy and allow for lower inflation to keep nominal spending on track. Proponents argue that by stabilizing the path of total income in the economy, NGDP targeting would lead to more stable employment and investment than any other framework. It's a single, clear target that deals with both sides of a central bank's mandate, growth and inflation, simultaneously. While no major central bank has formally adopted either price level or NGDP targeting, these ideas are no longer just fringe academic theories. They are at the forefront of the discussion about how to prepare for the next crisis. From the political failures of Arthur Burns, we learned the importance of independence. From the painful success of Paul Volcker, we learned the necessity of anchoring inflation expectations. From Ben Bernanke's crisis-era innovations, we learned that central banks must be willing to experiment when traditional tools fail. Now, as we look to the future, the debate continues. The tools and strategies used in the economy's engine room are constantly being refined, debated, and reinvented. The search for the optimal policy is far from over, ensuring that the work of central bankers will remain one of the most challenging and consequential jobs in the world.